Stephen, let me summarize for our audience. We're up to our eyeballs in petroleum, and the price is going to go down. Do I have that right?
Well, in the near term, we certainly are a risk to the downside. So we had the market that switched into contango. This is the NYMEX WTI crude oil market. Contango meaning that the price this month is cheaper than the price next month. That occurred on yesterday's expiration in the December contract. Why are we in contango? Well, simply because, to your point, the Zydeco pipeline, which is a significant pipeline that takes oil from the shale patch in West Texas that's being produced and takes it to the export market in Houston. Well, there's maintenance now that's going to last well into December on that pipeline. Right. So your oil flows are lower, but you're still producing oil in West Texas. So if you can't move it into Houston, you have to put it somewhere. And it's very important as far as the NYMEX is concerned, because where that something is going to be is up at the NYMEX terminal complex up in Cushing, Oklahoma. So we're looking at a situation where we're going to be building supplies at the NYMEX terminal complex over the next weeks.
The surprise to me, Stephen, as an amateur, is West Texas Intermediate breaches $70. We get a 69 print on American oil. Is that in your realm of possibility?
Excuse me. Yes, with regard to now, this was one of our more bearish cases. This is really at the tail end of our modeling of where we could go. But certainly, I do expect to see oil find a base here, assuming we do not go into a significant recession. And we have to keep in mind, this is the Biden put, right? This is the level, $70 oil in the low 70s that the White House has said. This is the level we're going to start buying oil to refill the SPR. So if you're sitting there, why would you sell $70 oil when the United States government's going to come in and start buying 200 million barrels at that price? So there, in effect, without recession, is your floor in the market, Tom.
So what about the ceiling, right? Because we were talking about the tight market about, 2 minutes ago, and we were talking about how oil prices were going to rise beyond $120 a barrel on certainly Brent and close to that on WTI. What's changed so materially in the physical market to make that completely an obsolete argument?
Yeah, well, excuse me, absolutely. So the 100 to 130, which is where we were in the first quarter, second quarter of last year, that's unattainable. That to say that we can get back up there, but we can't stay there because that's where we saw the demand destruction. So that is short of something catastrophic happening in supply in the market. That market cannot go up and beyond that. So what has changed now, of course, is the weakening economies around the globe. So it is a near-term bearish picture at this point. As we said, the Russians are front-running the price cap, so they've dumped a lot of oil on the market. The refineries in Europe, fearful of that price cap, have bought all that oil. So you're having a hard time now selling physical oil. So a lot of this physical oil is getting rolled forward into the first quarter, which is going to keep the market supplied. And the fear now, of course, is COVID with China. Right. When is that economy finally going to reopen? There is some optimism that it can reopen fully by next summer, but there's still a lot of skepticism in that. So without that demand in the market, you've got this lowest scenario of oil prices. I think in that low 70, low 80, I think this is the bottom of the market. And therefore, we're waiting for the demand because we think about this, CapEx is challenged. Interest rates are moving higher. Your hurdle rates for CapEx are that much higher. So you're still looking at a market that's going to be a dearth of capital, which is not going to go, of course, obviously, into bringing more oil to the market. So your long-term picture is still bullish. That still gets you back to that $100 range, but we just have to get over these short-term hurdles.
Could you foresee a time where you see the price of gasoline go down and the price of diesel stay high and even go higher?
Well, that's the new dynamic that we're in, Lisa, because right here in my hometown, Philadelphia, the once great epicenter of the East Coast refinery, we've lost 55% of our refinery capacity. So 3 years ago, we had a refinery in South Philly that produced or processed 330,000 barrels of crude oil a day. That was a lot of gasoline, a lot of distillate fuel that went right into our home market here in Philly. And then, of course, 90 miles up the Jersey Turnpike into Linden, New Jersey, in the New York Harbor market. We no longer have that. So that diesel fuel has to come from somewhere. And keeping in mind that gasoline is your best margin for a refiner. So this is where they maximize. So this is where you bring more gasoline to the market at the expense of distillate fuel, diesel fuel. So Steve, now we have to. Yes, I'm sorry.
This is so important socially, Stephen Schork, and you've been so dead on this. If we affect a shortage of heating whatever fuel in New England and the greater Northeast. How do you perceive a government response of this? I mean, what is the linkage of not in my backyard to government regulation, investment, incentives to fix this problem?
Well, the short-term fix is for this winter is the Northeast heating oil reserve, which you have 2 million barrels of heating oil sitting in tanks up in Connecticut,
really?
Rhode Island, Massachusetts, and you also have that for gasoline too. So that isn't in fact, and I'm surprised we haven't seen that yet, because here in Philadelphia, 45 minutes up the Northeast Extension, Allentown was out of diesel. They closed down one of their gas stations up there because they were out of diesel fuel.
Well,
so we are running shortages into this market.
Okay,
so that
but
is your
Stephen,
short-term fix.
Again,
Yes.
I don't mean to interrupt. I was in Paris, and on the way out to CDG, there were lines I've never seen waiting for a gallon of gas. Are you predicting that for Allentown or for Albany, New York?
Well, certainly that is the risk. I think gasoline, we're going to be, we'll get through this because that's where the price incentive is. But with diesel fuel, we're already running shortages, and that was shortages, Tom, before we even had any sort of heating demand in the market. So we're looking at the Northeast, the Mid-Atlantic, New England markets that are 70% of the homes or the market heats with heating oil. So that is an absolute risk that will continue all through the cold months.